Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to talk about a number of things. I want to tie together basically some of the concerns that you need to have. Okay, if you're not already concerned about some of these, I want to raise the concern because that's what it points out the importance of good planning. Okay, these concerns cause us to take action. So the more we recognize the risks that are out there, and then it's about developing a plan for them. It's not about getting discouraged, okay? It's about that there are positive things we can do to offset some of these risks. So one of those being, again, as we were talking about with Social Security, so we're putting together our plan here, all right? So we're going to go back to the graph here. I'll show you, as I left off, we talked about the operating fund, the emergency fund, and the short-term fund. So we're going to get a good, solid financial footing here is the goal, okay? So we start with, again, 1 month, we figure out what our monthly expenses are, and we calculate, and again, there's some of these that we pay less frequently, like maybe our, depending on if we're paying our home insurance directly or if it's going through some kind of an escrow and a mortgage payment. Ideally when we're retired, we have, we don't have a mortgage or it's a very small one. Now there's some other leveraging ideas that may come into play, but right now let's stick with saying zero debt, ideally for retirement. And then we've got our savings foundation where we've got an operating fund, an emergency fund, and our short-term planned expenses over the next 2 to 3 years. All of that is set aside in cash, ready to be able to take care of. Then comes our long-term fund. That's where we're investing. This is where our IRAs, 401ks, company plans, right? TSP, thrift savings plan. This is where those monies are invested. And this is, this is stocks, of course, bonds, mutual funds, exchange traded funds, and the like. So these are our long-term investments. This is where our time horizon is going to be longer. It's not funds we need in the next month to 2 to 3 years, but this is longer term. Now we're looking typically at 5+ years, and then even then, depending on what that need is, as to how we might face it. An example being if we have income needs, as you can see with the graph, what I'm showing you first is the different funds, right? Operating fund, emergency fund, short-term fund, long-term fund. That's what you're seeing on the left. And then a description of those funds as far as where those monies might be. And then the estimated average return depending on how, what the interest rate environment is over the long term. We're taking obviously a long look here, if you will, a long-term approach, as opposed to just something where we're concerned about the immediate next year or 2 years. Interest rates being very, very low right now. We don't want to think of that though over the next 10 to 20 years, what's the average going to be? And then on the long-term fund, that's the big one. That's where we're going to get our investments from our portfolios typically, and that's where we're going to pull income from when we retire and we no longer have wages that is going into these different accounts. Now we're going to be pulling it from our savings to feed into those, to supplement what we need as far as, to fill in for Social Security or pension or whatever it is that we need in addition to those to cover our living expenses. And again, the other part, it's important that we make enough money on that long-term fund to stay ahead of inflation and taxes, and that's what that little red box is about. And we estimate that could be 3 to 5% easily, depending on what's going to happen here in these ensuing years. So this is how you set up your plan. This is how you kind of segregate things out a little bit to get an idea, to make sure that you have a good foundation underneath. Here's something else. Even you do a great plan, right? You've got everything figured in, and then what might happen. Let me share an article with you. Majority of young American adults now live with their parents. Bigger share than at the height of the Great Depression, according to Pew Research. This is pretty amazing, right? We're talking about more 18 to 29-year-old American adults are living with their parents today than at the height of the Great Depression. This is the effect of the pandemic, basically. All right, and this is analysis from Pew Research Center of the monthly Census Bureau data. 52% of young adults resided with one or both of their parents in July, of this past year, up from 47% in February. So you can see the effect the pandemic had there. The numbers grew from 26.6 million people, an increase of 2.6 million just from February alone. And these increases came, this was kind of interesting as well, because it wasn't like picking out a certain group, right? Among all major racial and ethnic groups, men and women, metropolitan and rural residents, as well as in all four major census groups. So this is across the board, basically. Growth was the sharpest for white young adults and for those in the 18 to 24 age group of all ethnic and races. Most people in this youngest age group already lived with their parents, but the share grew to 71% in July from 63% in February. Again, when we talk about the boomerang generation has been referred to at times, but think of the effect of job, in particular in the service sectors, which a lot of young people are employed in, how that's affected them as far as through this pandemic, and how many, as we listen all the time, small businesses going out, restaurants, the service industries in particular, these people losing their jobs. What's happening? They're coming back home. We're talking about inflation and effects there. What about the effects of maybe having to help your kids out? Do you have a plan for that one? We'll talk about that and more, but first a break. Join me here. We'll be right back on the Retirement Report.